So when an offer comes in, let's look at the one that came from UMB. It was a really good offer, 1.75. This was about 80% loan to value on this deal.
Okay.
At 3.55%. Here's the 80%. All the requirements they say. This is the offer they actually went with. So it was a really good offer.
Are you guys, why don't you explain to me a little bit about what StackSource does, and then we can kind of take it from there.
Sure, absolutely. So StackSource is a tech-enabled commercial real estate loan brokerage firm. So essentially what we do is we connect borrowers with lenders, and using our technology really gives us three benefits. One is we're able to get to the right lender faster. So we get more offers in a faster manner. So that's really our competitive advantage. And the second thing is we provide transparency throughout the process. So as a borrower, some borrowers like to have, hands-on approach. They want to know where everything is at any given time. Our technology provides it. Other borrowers don't really care. They just want the offer. At that point, you just ignore, the technology. So it helps provide more transparency. And then the third is that we add a lot of value through our technology and transparency and our human connection without charging extra. So our fees are 1% of the loan amount, similar to every other brokerage. We do offer discounts on the second deal and moving forward. But really, we've built this technology to help reduce some of the inefficiencies in the marketplace. We're able to get offers, in some cases within a day, but really our best offers come in the first 2 to 4 days. We're able to make better connections. We're able to negotiate better because of that technology as well. So that's what we do. We haven't removed the human element from this business, but we've learned to leverage the technology.
Gotcha. How many lenders do you work with?
There's more than 1,000 on our platform at this time, and we're adding more every day as we get their credit risk profiles. So essentially what we will do is we will get lenders to fill out our forms, our intake forms that will have them share with us the kind of loans that they're aggressively pursuing and their credit metrics. So our technology will, read the loan, read the request, analyze the loan, and then match it with the lenders that are aggressively going in that marketplace. So if you're looking at Arkansas or Texas, you'll get matched with the regional banks, credit unions, national banks, credit unions, CMBS, agency, private money, depending on what the need is. And then, we'll match it based on asset type, location, loan amount, cash flow, borrower details. There's, I think, 30 different metrics that we match on. And so that way, we're not calling 100 institutions with the same loan. We're going to 5 to 10 that have shown us that they are going to aggressively lend on that. And that number is always growing.
Gotcha. So there's about 1,000 lenders on the platform. And then as you kind of dig into the qualifications or where the loan's located, then that is obviously going to contract a lot to the point where you get probably a mix of some regional and some national lenders that kind of compete for, that product depending on where it's at and the value.
Exactly. And this will range from private money, debt funds, CMBS, agency, banks, credit unions. If there's a source of financing out there, a type of structure, then we'll go after it and find that for you.
Okay. And then you're getting paid a point. Is that from the buyer, from us on the acquisition, or is that from the is that like a origination point from the lender?
It's from the buyer, and it's due upon at commitment from the lender, but it's really paid at closing. So it's contingent on that. The reason why we don't collect from lenders is to align our priorities with yours. to make sure that we're getting you the right information and the right options for you as compared to what will give us a higher paycheck from the lender. So
Understood. So you're an advocate mostly for the acquisition team then for the buyer.
Correct.
Okay.
And that's, that's how we've built our business is with different equity funds. We've aligned ourselves to be their financing arm. So, they'll identify the deal, they'll do their due diligence, but kind of leave us to find the financing for them. And as we build that relationship, the underwriting on our part gets easier. The ability to sell that loan to lenders gets easier. So we share some of that efficiency with the borrowers as well, as early as the second deal.
Okay, understood. So when it comes down to it, basically, we're packaging up the loan so that it goes to, it gets sent out to the 1,000 lenders or so. And then when it comes back and there's indication of interest from, 10 different lenders, then you're making contact with the 10 lenders, making sure that they have everything they need to present a commitment. And then once we've received 2 or 3 commitments that make sense, we just choose the one that's going to probably perform the best or going to be the least expensive. And at that point, we're going through the 30-day underwriting process with them. Are you doing most of the processing on your side? What we're finding is that the appraisal is basically taking 3 to 4 weeks for most of these projects. And, the appraisal is holding things up and causing, 60 to 90-day closings where it could be done in a couple of weeks.
Yeah, we're seeing that across the board. We don't deal with appraisers ourselves. The lender works with them independently. But we do get that commitment from the lenders upfront, what kind of lead times they're seeing. So before you make a decision, we'll share with you, this is a lender that we've closed with in the past. They take 30 days, and the biggest bottleneck for them is appraisal. There's a bank I work with in Texas. They get appraisals pretty quick, but they take forever to underwrite. And their estimated closing time is about, 50 to 60 days. So the appraisal is not the bottleneck there. So we'll share all those idiosyncratic things with you as part of your decision process. But if you don't mind, I'll share one thing with you. Can I share my screen? So
yeah, let me open it up to you here so that you can share it.
So this is what the platform looks on my end, and it should look very similar in your end when you're inputting a deal. But we go through, we verify, all the information. We put this package together. It has all the information that lenders typically want. And this is kind of created per the lender requirements. It kind of creates that check mark box. So once this file is complete, we write like a quick overview of why the project is good. And once we have our pro forma, our request, and the file completed, we'll send it out to lenders for their review. So this project matched with quite a lot of lenders on our end, and there were a few that were added after the fact. But he pointed out that he had a relationship with First Bank, so we excluded reaching out to them. But all of these lenders received the file. Some of them declined it. Some of them just didn't open it in the time period we require our lenders to be responsive. Some of them told me that they don't want to do the deal. And here's ones that viewed it but didn't give an offer. And here's the ones that gave an offer. So when an offer comes in, let's look at the one that came from UMB. It was a really good offer. 1.75. This was about 80% loan to value on this deal.
Okay.
At 3.55%. Here's the 80%. All the requirements they say. This is the offer they actually went with. So it was a really good offer. But what's really cool is you can compare different offers coming in. So I'm going to compare the 4 that we were looking at. We put it in a table, makes it easy. You probably have your own method to analyze loan offers. But this is a quick and dirty, analysis that shows cash and cash return. It shows some of the more important terms to some borrowers, so recourse, prepayment, collateral, and those tend to be pretty similar. But it shows, your net loan proceeds. This was a cash out refinance, so this is in green. But otherwise, it would say down payment on how much it would take to get the loan done. So this is how we do it. Once you like an offer, you go in, you accept it, and then I will work with you from that point to work with the borrower or work with the lender to make sure that the loan gets done in a time period that's acceptable, and that they don't really change up their terms on you. So the technology allows us, and you have access to log into your loan request at any time and see all of that information at any point. So you don't have to wait for me to get back to you to respond to an answer, respond to a question. You can log in and see it at any point. So you have more transparency than most lenders would share.
Definitely. So is that basically a typical scenario where a loan package gets submitted and you get 30 or 40 different lenders that look at it, probably half of them just decline it because it doesn't fit their criteria, another half of them after looking at it, it doesn't fit, and then you're down to about 5 or 6 that it actually makes sense, and then you put them into a spreadsheet, analyze what you're looking for, either rate, terms, or payment, and then just choose the one that's going to fit.
Exactly. So sometimes, one of the lenders out here was Banner Bank. They're a good bank. They do a lot of good stuff, and they're competitive in the right asset types. But they've shared with us that they want to lend on owner-occupied retail. They're just not competitive in it, and they know it. So when a deal like this comes to them, he'll look at it. He might reach out to me via the platform or email or phone call and say, "Hey, I like the deal. Unfortunately, my rate's going to be 5%." And I'll tell him that, "Hey, I don't want you to spend more time on this because you're kind of not competitive there." So then he'll go ahead and decline. So it's not necessarily that they're just, not a fit. It's just they're not competitive in that space. They'll lend on it in a pinch, but our goal is to bring competitive offers with unique structures that help you identify the best strategy. But I'll tell you, on this deal, 5%, regardless of what strategy you went with, it wasn't going to be competitive. So he declined the loan from that perspective. And then there's just, there's always that change in concentration risk at a lender. Sometimes they have too many mobile home parks and they're just on pause for it. So if a mobile home park deal goes to them, unfortunately that week, they'll decline it. And then he'll let me know that, the deal is still active in 2 weeks, send it back to me. But that's how it typically works is they'll match, our system will match about, 30 to 50, some cases less, where we have more information, we can actually narrow it down to the right number of lenders. But I would say we would initially reach out to about 30 different lenders at most, gauge the interest that's coming from them. Then we would narrow it down a little bit more to the ones that are being more competitive. We'll negotiate the ones that we actually like the most. So in the example I showed you, UMB, we negotiated that down from 3.75 to 3.55 because we had leverage with other offers. I had worked with them before and I knew what their pricing scale is. We were able to get a little bit more of a discount for the borrower because he wanted to move his depository relationship. So we were able to negotiate that down, 20 basis points. But yeah, that's essentially the process is. We start with a wider net, narrow it down, and then when we have 1 or 2 offers that we're contemplating between, we'll go and negotiate a little bit more to get the right deal.
Understood. So most of the projects that we're working on are going to be multifamily. They're going to range in value from probably 800,000 or 900,000 to 8 or 9 million. Do you work with any agency products at all?
Fannie,
Freddie, HUD?
We do. And I will actually show you another really cool feature that we have. And I'll send you a link to this so you can use it for your analysis. But I'm on Crexy. I use it for analyzing, my personal investments. So I'm going to just look at an apartment building in Colorado. They'll give me some options. So let's take this one. So we created this Chrome extension up here. Also, it pops up right here. But it's an instant quote for multifamily. And this is through agency lenders. So it is backed by Freddie Mac and the HUD. But this tool will pull the information in the operating memorandum. And I can choose Freddie Mac or HUD. Let's say I go with Freddie Mac on this. Actually, let's go with the HUD because it's a more competitive quote. Rent affordability, market rate. It has a zip code. How much loan to value I want to go. I always do maximum because the system is smart enough to calculate what the maximum should be. And then if I click, give me a quote, it will run its magic and it will tell me what my loan would look like. So in this case, we're looking at a LTV of 85% at 2.73%, 35-year amortization. Fantastic.
Right.
But this allows you to get a really good starting point on agency loans, what they would look like for that particular property before you even get under LOI, put together the package, send it to the lenders. So we're finding this to be a pretty successful tool in the marketplace.
The only issue that we're having, I think, with most of the agency products is just the timing that it takes. You know, as far as HUD to fund.
A year.
Yeah. How long is it going to take? 6 months?
It takes about 9 months to 12 months, but we have partnered up with one of the bigger agency lenders where we have a bridge lender that will do not the same terms, but they'll do like a 1 year interest only loan, around the 3.5-4% mark. So you have that bridge for a year that is competitive with going with a regional bank, and then you transition into HUD as soon as they can fund. But yes, I totally agree. HUD has its pros and cons. The cons are it is more expensive than regional banking in terms of closing costs. It is longer. It takes 9 months to 12 months, and it requires a very particular type of asset, very particular type of occupancy, ownership structure, things like that. So if your product fits in HUD, you don't find better financing than that if you have the patience. But we have a bridge program that leads into HUD as well.
That's great. So you do have is it private? Is it hard money? Is it conventional? The bridge?
It's a conventional.
Okay.
It's a debt fund that's partnered up with one of the agency lenders. And so from your perspective, you see 1.5 times, origination, if you think about it, instead of doing a bridge and then refinancing a year later. It's not the same effort as 2 loans. It's kind of more than 1, but less than 2. So it is a unique product that, does help investors when they have a deal that does qualify for HUD. But if you have agency, we can work with agency lenders to get that deal closed as well. Freddie Mac, Fannie Mae. We've done those deals. Again, we have the same tool works on Freddie Mac live quotes. As part of getting that offer formalized from the lender, we do ask how long do you think it will take. If it's longer than your contractual obligations, we do ask for a bridge loan from that same lender to reduce the cost on your end, to reduce the pain on your end. And if for some reason that doesn't work, then we will work with other lenders who will be competitive enough. Typically, agency loans are cheaper than banks and credit unions, but only marginally. And if they can't close the deal in time, then they're really not an option. So then we will work with banks and credit unions to also get you offers that can close faster. And if you're looking at a value add deal, we have private money lenders, we have specialty lenders that like to do multifamily construction. That's all they do. We can help with that. But really, yeah, I guess my point is that, we've compiled a list of lenders. We've gotten information from those lenders that allows us to create an option for pretty much any strategy in commercial real estate. And where we are kind of stumped, we have really good relations with some of the lenders where we'll get you on the phone, say, talk to the lender, see what you're looking for, and we'll help creatively come up with a financing solution that works for your deal.
Understood. Okay. Let me give you a typical scenario. The last project that we did just closed in Huntsville, Texas.
Okay.
It was 22 units, $3 million.
Okay.
We basically syndicated out about half of the ownership to, I believe it was 8 different individuals. And then my partner was the main general partner for the syndication. Raised about 800, I think it was 850,000 just for the down payment, some improvements and things, and then got a regional loan for the 2.3 that was left over on that. That's kind of a typical deal that we do. And so I think the main thing that was the pain point for that transaction was just the timing was it was a little bit over 90 days. It was about 100 days to go from contract to close. And, the appraisal, like I said, took probably 4 or 5 weeks just to get that back. But then, underwriting and everything, it was a little regional bank, took another 4 or 5 weeks.
Which bank was it, if you don't mind me asking?
I'm not sure. I have to get the actual, it was a smaller regional bank though.
Okay.
That's why I don't know the name offhand. I just thought it would be great to have a national lender or somebody that had a process that was already in place, and probably a bank to go to, or a regional company that would allow them to outsource the appraisal or to get it completed quicker. I wasn't sure if there's anybody like that. I mean, your typical deal, what you're seeing right now, how long is it taking to close? And are there any ways to speed up that process so that I guess it would give us better terms when it came to negotiating with the seller and being able to close quicker? And I always thought that maybe having a line of credit that would loan, instantaneously, maybe for 5 or 10 million, that would allow us to fund 80% of the deal up front, kind of like that bridge that you were talking about, until we got to that either conventional or agency product or HUD product at the end, would be ideal. But I just wasn't sure if that was even an option.
No, you can get a line through a private money lender. They're expensive, when you draw on them. The other downside of that is when you go to refinance, a lot of institutions, cap cash out refinance. And at that point, your loan to value goes down from 80% to 75 or to 70. So that causes that pain in, yes, you're able to close the deal faster, you're able to negotiate better upfront. But when it comes to, pulling equity out of the deal, it becomes a little bit more challenging. I don't know the exact average number of days it takes to close a deal, but I would think, since we do work across different asset types, we're probably looking between 30 and 45 days from when you select an offer. We can expedite that through having a better, more completed file. So, there's some documents all lenders will ask, tax returns, things like that. If we have that ready to go day one, if we're able to put down the deposit for the appraisal on day one, we can likely expedite and cut that time period short. But, from my experience, the best way to know how long it will take is to ask before you select an offer, saying, hey, I need a commitment from you on how long will it take to close, and I will make it a point to get you all the documentation you need, answer all the questions you have in a timely manner. Here's the complete file that you asked for. From now, how long will it take? And, unfortunately, appraisals are really backed up. We're still seeing 4 weeks to get a full report back on a multifamily property. And my favorite lender in Texas, that's their bottleneck is, if you give me everything on day one and we order appraisal on day one, by the time the appraisal comes in, the deal will be approved and ready to fund, subject to appraisal. So we're waiting on an appraisal to come back. It could be next week. And at that point, we'd be closing in about 18 days. It could be the week after that. It would be 25, could be 32. It's appraisals outsourced, and there's only, so much we can push for.
Sure. Okay. So the average time, like you said, is probably about 45 days or so, beginning to end. Typical due diligence period, probably 30 days or so. So it's not going to be too much longer from the end of due diligence to close.
No, it shouldn't be. But on a typical timeline, for the deal that you created, if I get all the documentation I need from that, I can have it out to lenders today. We'd give it a week to shop the best offer. And I'd touch base with you, and you'd get updates from the system every time a new offer comes in. But I would schedule time on your calendar next Tuesday saying, hey, we need to connect to talk about the offers, the pros and cons of each. And then on Wednesday of next week, I would go to the two lenders that you like the most, negotiate on your behalf to try and save you some money. But end of day on Wednesday next week, we would select the lender and start their underwriting process. So, it could be that, by the time your due diligence period ends, you have a loan ready to fund if the stars align. But it could also be, 15, 20 days after that.
Got it. Okay. So this product the deal that I just put in, we have financing that's probably going to be, it's going to be ready to close probably prior to you guys being able to underwrite and do everything. So we do have another one though that just went under contract. It's in Little Rock, Arkansas, that I think would be a good deal to start with. It's a smaller deal. It's only $800,000 purchase price.
Okay.
But I think that if we can get that one going and kind of work our way through the system, that might be a good starting place. And at least at that point, you'll have the personal financial statement, the REO, the documents that you need. And then as we go larger and larger, it should be a much easier, more
absolutely
streamlined process.
And an unintended consequence of that would also be for you, on an $800,000 deal, it knocks the first deal out pretty cheap on commission expense perspective. Mm-hmm. And then your next deal, I'd be able to shave, 10 basis points on our fee. So, you're saving a little bit more on a bigger deal from that perspective.
Gotcha. What are the deal sizes that you're typically running through right now?
I think our average is about 2.5 million. I think our sweet spot is really between that 2 and 4 million. Smaller deals, I like to work on smaller deals. And one of my colleagues, his name is Chris, we're the ones who kind of focus on the smaller deals. And then we bring in, if you're in Arkansas, I would bring in Andrew. He's the one who kind of goes after that. But I would serve as your single point of contact, bring in the right people to work on the right asset type, right geography, right deal size in order to maximize your financing options. So each of us have kind of figured out like what we enjoy and what we like to do. And then we work kind of together to serve our clients, have a single point of contact, have the accountability, but also get the benefit of, deeper specialization in different markets. But what we find is between 2 and 3 million is our 2 and 4 million is our sweet spot, is where we get our best offers. But while I have you, so the deal that you're closing in Texas, the one that you put through the system, what kind of terms did you get, if you don't mind me asking?
It's I believe it's 20% down. It's a 25-year amortization. I think it's 4 is the interest rate.
Okay.
Yeah, it's a pretty basic regional bank that's there, and so my business partner, who's also an attorney in the Air Force Reserve, he's a great guarantor. He's been doing these for about 4 years, and now he really wants to ramp up. He's been doing about 2 or 3 apartment deals, kind of syndicating them out to friends and family, and doing most of the general portion of it himself and his law firm. He's now starting to branch out, and we're going to hopefully be able to close about 8 this year, and then
Wow.
12 to 15 next year. So, we're really looking to get about 1 or 2 a month kind of into the pipeline and take it from there. So that's why the lending is the biggest portion right now. That's the bottleneck. So we're really looking to facilitate that and to streamline it as much as we can, because if the underwriting and the lending's there, then there's no reason why we can't close 1 a month. And we're looking at mainly Texas, Arkansas, Nevada, Florida right now.
Okay.
But I live in San Diego, and there's just nothing in California that really makes a whole heck of a lot of sense.
Yeah. I lived in LA for 9 years, so I can understand the challenges of that. And my wife's actually from San Diego.
Okay.
So I totally feel you. Those are, hot markets for investors. If you go down to Florida, I would bring in another advisor to assist on the deal. They know the lenders there better than I do. They know the market there better than I do.
Are there specific areas in the country that you find are hotter right now, or easier to kind of push deals through?
Easier to push deals through, not necessarily, but in terms of hotter, Texas is really hot. I've seen Idaho kind of getting hotter and hotter. Indiana is pretty hot. Arkansas, Oklahoma, Kentucky, they've been increasing in deal volumes from our perspective. And then, Florida's been pretty consistently strong. Nevada's been consistently, above average, but I wouldn't necessarily say hot. California is difficult. You get the construction deals there that are big dollar amounts, but we don't get a lot of volume, like we do in Texas or, some of the other markets. But yeah, when you think of where you're looking to invest and the criteria you're using for analysis, those are, typically the ones that we see most of our investors use as well. And especially the out-of-state investors kind of, flock towards Texas, Florida, Indiana, Idaho. Those are the 4 that I've noticed more and more.
Okay, great. And as far as your company goes, how many are there, or how many people are there in the company?
I think we're at 20 at this point. And I would say our technology adds capacity of another 10 easily. So keep that in mind.
And your role, what is your title?
I'm an associate capital advisor.
Okay.
And I'm based out of Denver, Colorado, but I cover the Texas market pretty every day. Yeah. And
are the other regional advisors, or you kind of break everything up regionally, or is it by deal size or by capacity, or what do you do when are there about 5 or 10 guys like you that are all looking for, selling to different areas of the country? Exactly.
So we've, identified our market spaces. So mine includes the Idaho, Colorado, down to Texas, Oklahoma, Arkansas. But we work together a lot as well. So, I do well in multifamily. But one of my colleagues, Beth, does really good on construction and value add. So if there's a deal that comes in, in my region or through one of my contacts, I'll still bring her in because her expertise in that market, in that asset type, is invaluable. And, similarly, what we do is we partner up with our clients and become single points of contact. So that way you don't have to tell your investment strategy and story to every advisor you work with. You tell that to me once, I'll collect basic information on you upfront. And then when you go to do a deal in Florida, I'll bring in the capital advisor who focuses on Florida, and then he and I will work. I'll work more with communication with you, and he will work more with the lenders to get the deal that works. So we form these mini teams for each deal or every other deal to make sure our borrowers, our clients are getting the best service that they can get so that they keep coming back. Because essentially what we work with is primarily equity funds who are looking to do, 4 to 10 deals a year. And then we position ourselves to become almost like an analyst for your team to bring you those offers where you can, scale up pretty quickly.
Great. Yeah, that's what we're really looking for, is just the ability to partner with one lender that allows us to just kind of front run the deal, to basically say, okay, this one's under contract, we need we need it closed as quickly as possible, and then let you do your job on your side, figure out which lender is going to fit the bill for that particular deal, and then get it into underwriting and get the appraisal done and get it closed as quickly as possible. I would like to at least get one this year into some type of an agency product, possibly do that bridge loan like you were talking about. And I'm not too sure. I mean, the process obviously is the process. It's going to take a year and it's going to be challenging, I guess, along the way. Do you see any potential pitfalls when it comes to that? I mean, if there's some reason we can't line up that HUD loan in 9 to 12 months, is there I guess we just put it into a conventional product at that point and refi that bridge?
Exactly. The biggest pitfall though is hopes and expectations. When you're looking at a sub 3% loan on a 35-year amortization at a 85% loan to value, all three of those elements are really, really, enticing to borrowers,
Right.
So having to pivot from that to a loan that's 75% LTV or 80% LTV at 3.5 to 4% on a 25-year AM, there's a lot of expectations that get hurt. So as long as, what I work with all my borrowers working on a similar HUD or agency deal is, that's the best case scenario. Let's also model out what the worst case scenario is. And then that way, if you have to pivot 6 months in or 8 months in, what to expect. Obviously, rates change and terms can be fluid. But, having that contingency backup plan can be helpful. But the biggest pitfall is, hurt expectations and, it could have been so great if that deal had closed that way. So,
yeah. Are there a certain amount of deal flow that you see that go into the agency or HUD programs each year? How many would you say? Is it a handful? Is it like 5 or 10?
Yeah, I would say it's only a handful because most borrowers are impatient and don't want to deal with, the longer term underwrite, the longer term financing, given the risk that it comes with having to, turn back to conventional anyway. And, that's just my personal opinion. I can run a poll on our system to see what the other advisors think. But yeah, I would say it's primarily a handful. Most of our deals typically go, regional lenders or national lenders. And in certain markets, if you're looking to buy multifamily in Midland, Texas, we'll find you a local lender that knows that market and will be more aggressive in that market. And we'll kind of, stroke their ego a little bit, saying you don't want, a Bank of Texas to come in and dominate your market now, do you? So, we'll start with local as well. But I would say most of our funding comes from regional and national lenders still.
Understood. Yeah, I can see that. I can see the reason why for those. As far as the agency loans go, is there a certain deal size or area? I know that they're location specific too, because they don't want to lend into the B or C markets. They typically want to be in the the higher occupancy, bigger markets when it comes to their loan portfolio. But is there a certain niche that I can look at and say, okay, this one would probably fit into a Freddie product, or this one might fit into a HUD product?
So I'll send you the link to our Chrome extension. The extension will realize if it is on the surface eligible for a Freddie Mac or a HUD loan. They're not, from my understanding, they're not region specific. They're government focused or government sponsored. So they'll lend anywhere in the country so long as it meets certain criteria. The biggest criteria is price. It needs to be, I think, 1.5 million in loan amount. And then occupancy. Fannie Mae and Freddie Mac require 90% occupancy for 90 days, or the last 90 days in order to be eligible. HUD requires 85% for 6 months. After that, if the deal sizing works, then in some markets, you submit it for a pre-approval before it goes into underwriting. And at that point, they're looking at, the quality of the asset. They're looking at, what the crime statistics are in the market. Was there a shooting on site? What is the environmental impact of that asset?
Are they going to require a phase one?
Some do, some don't. It really depends on, the information is available at the time. But yeah, I'll send you the link to the Chrome extension. It can be very powerful when identifying those assets. Sometimes we think it is, and there's just an underlying criteria that we miss doing a quick analysis, but that system will catch it.
Okay.
And then it's nice to be able to see, oh yeah, this, here's an instant quote. And then we do have partnerships with agency lender that will honor that quote. So if you get one and, it is an initial quote, there are other contingencies, it is non-binding, but as long as you qualify for it, they will honor that structure. They won't come back and say, the rates have gone up or, LTV is changed. So long as the loan qualifies, they will honor that rate.
Great. As far as Freddie goes, is that still going to be a 9-month process, or is there any way to shorten that?
That will be quicker. I would say 30, 45, maybe 60 days, depending on the market that we're in, and if it's a pre-review market or not. But I would say it's almost like a conventional loan at that point.
Okay. And Freddie's product is pretty good. I mean, obviously HUD would be ideal, but Freddie's product is still pretty good.
Absolutely. So I will run the same property through Freddie. The only difference is live quote. If you're looking for the best rate, go with yield maintenance, but I won't do that for you. But I mean, same property, we were looking at, I think, 2.75% on 85% LTV. It's a point higher. Leverage is significantly lower. And amortization is 30 years. So I'm guessing the LTV was capped by the debt coverage ratio. In this case, I think this one was it's a 4.6% cap. So it's not a good deal. Not a good enough cash flow to support a higher leverage. But that's the difference between, Freddie and Fannie or Freddie and HUD is. One is more aggressive with the debt coverage ratio. But hey, here's a deal sizing. It happened in a minute, pretty nice.
Yeah, great. Hey, do you own any apartments yourself?
I do, primarily in the Colorado market. Okay. And I have one in LA. It was my first home, but most of my investments have been in Colorado so far.
Great.
My personal strategy has been, my wife's an agent, so she front loads a lot of that. And then we syndicate as well. And, I'm transparent with my investors that, hey, I'm getting a little extra income right off the front to the agent fees from my wife, but that allows me to not charge you an acquisition fee or, for my legwork. So that's been our strategy is let's vertically integrate our process where we can make a little bit more from the legwork without charging our investors more.
Perfect. Well, that's good to know. I always appreciate dealing with other investors too, because you're in the trenches with us. So that makes sense.
Oh yeah, absolutely. I enjoy it. I enjoy complex deals, coming up with unique, creative financing. Because, good financing can make a bad deal good, but bad financing can make an exceptional deal really bad. So.
Excellent. Well, I want to finish up here, but why don't you give me one last question I just had was, what's probably one of the best deals that you've seen recently?
It's one that I'm working on right now. It's a mobile home park portfolio in Iowa. So there's 4 parks. They're 60% occupied, so they're not very desirable. They don't have a lot of infrastructure. The roads aren't paved. Septic tanks instead of utilities. Landscaping look bad. So it's 4 separate parks, and we're working to get them 75% loan to value on acquisition, and 70% of all improvements being made. It's coming in at about 375 on a 30-year AM, but that's 70% of the construction budget is in the form of an escrow account. You only pay when you draw on it.
Right.
So it's essentially what it's done for them is, it's a value add play. So instead of getting a bridge loan, paying 8 to 10% on it, they're getting a bridge loan at sub 4. And, at that point, there's no prepayment penalty, so that in a year, once all their value add is complete, they can refinance it, pull some equity out if needed, or they can just leave it as is, considering it is a permanent loan type. So, we did get creative with the extra first and second position loans on that, with the same lender, fully, transparent on the pitfalls up front to try and make that happen. But, small market, difficult asset type, unique situation with the value add, low occupancy, and still being able to provide them like a short-term solution that serves really well as a long-term solution. I think that's one of the more nicer feelings to get when that offer got accepted. It's like, this is more than anything I asked for. So
yeah, no, that's great. We have one value add, I think, that's going to be in the pipeline here that is going to take probably, I don't know, $500,000 to do the rehab to the actual units themselves. And we were trying to figure out if there's a product that would allow that, 500,000 or so to be financed into it. And it sounds like you said 70, so 70 acquisition, 70 for the actual work.
75 acquisition, 70 for the actual work. I do have a similar project in Texas. That one was a little bit easier because the guarantor's net worth was astronomical. But it's in Killeen, Texas. So between Austin and Dallas. Multifamily, they own it, and they are looking to renovate half of the units that are in the multifamily. And they're getting waiting for the appraisal to come in. That's the one that could close next week or a week after. But they're similar product. We're refinancing their loan amount as of right now, and then adding about $600,000 worth of escrowed account funds that they can draw upon. It's 2 years interest only. And then at that point, the borrower's intent is to go agency anyway. So we didn't argue to, try and increase anything or really change much. But they're getting $2.8 million to pay off their current debt, and then $600,000 for the additional construction budget they have, for 2 years interest only at 4%. So it's a bridge. It's a bridge because it doesn't have the long-term amortizing loan at the end of it. But it's a bank. It's a local bank. They would love to keep it on their books at that time. But they were going to give a prepayment penalty if we had that amortizing part to it, whereas the borrower wants to go agency once the construction is complete, and once they've stabilized it to have that 90% or 85% occupancy for the required time. At that point, they want to go agency. So, we figured we'll give up the benefit of a permanent solution to have the flexibility of a no prepayment penalty. So definitely exists. It just requires a little bit more legwork on my end. Doesn't, change your experience, doesn't change your cost or anything like that.
Great. Well, I appreciate everything. I got to wrap it up here and get on with the rest of the day, but I will input our next deal into the
Okay.
system, and then I'll upload all the documentation with that. I know you were going to send over the Chrome extension. Is there any
Yes.